Hello everybody, welcome to Economica. Welcome my friends. First of all, thanks a lot for all of you that are watching my videos. I hope you enjoy my content. If you're new around here, you can subscribe, just thumbs up with a like, or leave a comment, or write whatever you want. And yes, thanks a lot to all of you. And if you are not watching my video, you should really do so. That's very rude that you're not watching my videos and subscribe. And yes, so today I made a last-minute study about the inflation, CPI, core inflation data, and also the producer price index data. A few variables around the PPI, core producer price index, commodities producer price index, so a few different flavors of the producer price index. And yes, I've just like everybody else, we just saw the data coming out from the Bureau of Labor Statistics about the inflation and core inflation of the United States in the past months. And so I'll try to walk you through the simulation data that I managed to bring together, and to figure out more or less what could be a pass-through effects of the 25% import tariffs. Although I don't think it's I don't think it's very precise, because tariffs, they are on specific items like aluminum or steel or so. But anyway, I tried to run some codes and have a broader idea of what would be the bump effect on the or the inflationary pressure on CPI, core inflation, and producer price index. So let's go on our Greek calendars to the never. So we saw that core inflation year on year for the month of February came in at 3.1%, so decreasing month on month. On a yearly basis it was 3.3%, so there has been a decrease in core inflation rate. Also the CPI, ordinary inflation rate, has decreased from 3% to 2.8%. And also we saw that at the same time, a little bit later on, the Bank of Canada, the Central Bank of Canada, has decided to cut its money market, its bank rate by a quarter of percentage points, from 3 to 2 and 2.75%, 2 and 3 quarters. So we see that there is a overall trend, or a try of decreasing money market rates across central banks, across different economic areas. And nonetheless, after this data, after the inflation data, there will be the producer price index data, and then next week there will be we will leave to the Federal Reserve to do what they want to do. But anyway, so we have here that inflation is steadily decreasing. These are the February data. Will be interesting, of course, to see what will be March data, and we know that from April a wider array of tariffs, they will be put in place across Canada, Mexico, Europe, also the what is that island on Nutters? Yeah, the United Kingdom. And so we will see after April how the tariffs will basically fit through the inflation data, the inflation parameters, and what will be the commodities of the materials and all the products that will be affected by the tariffs, if there will be supply chain frictions, and there are lots of moving parts, of course. And so it's I have to say, it's fair to say that it's not an easy task to forecast, to have a precise forecast of what the 25% tariffs on a broader inflation parameter or a producer price parameter can basically develop into. So let's get on with the data. So okay, I'm just as usual we take some time series from the Fred database, and what we have here is this is core inflation, this is normal CPI. This one is just bear with chunks, bear with me chunks, bear. Okay, this is a consumer price index. I'm reading from the Fred website. For all urban consumers, it's commodities less food and energy for average. In USC the average, okay, so it's seasonally adjusted, so it's I repeat, it's a CPI index for all urban consumers of all commodities excluding food and energy, so it's another sort of measure of core inflation. And this one is the median CPI. Yeah, this is the median CPI. You can read this is sticky prices, and this one is a producer price index for all commodities. Then this WPS. Okay, it's another measure of PPI. This one, and it's a producer price index commodity. It's a end demand excluding food, energy, and trade services. So it's core commodities excluding its final demand of core commodities excluding food, energy, and trade services, and the base year index is August 2013. Then these other ones, eventually it would be a similar producer price index. Let me see, bear with me 1 second, because I'm also running codes in the backgrounds and stuff like that. Oh dear. Oh yeah, sorry. Okay, hold on with me 1 second because I'm messing around these things. Okay, so this historical data are a producer and demand producer price index, yes, excluding energy, food, and trade services. This is core producer price index, core PPI, which is very similar to core CPI. Yeah, and this one, it's last but not least, it's the producer price index for manufacturing. It's not seasonally adjusted. So we have these data, and they are from 1990 on a monthly, 1990, and it's every month the data is collected. We see January, February, and March, April. So it's quite some long historical data. So basically my aim has been to, first of all, to find the OLS regression, so to see for each dependent variable how it's so each of these variables, like CPI, core CPI, producer price index, core producer price index, the median CPI, the sticky prices, I've basically I interpolated, so I made a linear regression, let's say. I take one variable, let's say CPI, and I ask the machine, okay, I want CPI to be the dependent variable. Can you tell me what happens to inflation when all the other variables that I have that I gave you as a data, are they moving around? So when, for example, the core producer price index variable goes up or down by a certain percentage, what happens to inflation or to core inflation? And so this is called, in jargon, is called a OLS regression. And with that, and a multilinear regression, with that we try to find out and to see how these parts in the economy, how they work together, how producer price index can have a push-through effects on inflation, and how inflation is correlated to producer prices and vice versa. Then I tried to to figure out, well, I asked the machine, I coded into the machine what happens to these variables if there are 20%, 25% tariffs. Then I coded into the machine to optimize a autoregressive moving average model, a RIMA model, and also a seasonal autoregressive RIMA models. And then I asked the machine to show me what are the conditional volatility and to forecast the conditional volatility of this time series. So it's a very broad array of data, and so let's get on with it. And first of all, we can see that for some tests, these historical data, they are stationary. The ADF test tells me that the data is stationary. For the KPSS test, the data is not stationary. So it's a very simple thing to understand, that if we take the data as they are, like this, these are we see the charts. When we go on a website and we check for inflation, we will have a chart, which is this one, okay? And so we see that there is variability in the chart. So in order to study what happens to inflation, we have to filter out all the excess volatility and all the square residual errors, and then we can try to find out how these time series are correlated and what is their behavior. So after that, I called the machine to show me what are the charts for the first difference, and as the other day I said, okay, the first difference is xt plus 1 plus xt plus 2, okay, because it's a time series, it's dependent on time, okay, so x, y, z, t. Well, it's not really like that, but anyway, let's assume it's x, y, t without the z, okay, let's exclude z, we have x, y, and t, okay. So the first difference, what makes for you, it takes the following period, t plus 1, and it subtracts with the previous period, xt, and then it comes out the difference between these two data, and with the difference you can filter out the seasonality or of the and the overall trend of the data. So if you just see these charts, which is inflation rate, CPI, it's very, very different from this one, not only in the scale, but this one it has a seasonal trend. By taking the first difference, we exclude the seasonal trend, and we just end up with the difference data, which are very, as you can see, they just move between 1 and -1. So our aim is to narrow the range of the data so that to have less and less volatility as possible when we study the data and we want to make a forecast. Okay, so then we see from the autocorrelation and partial autocorrelation charts what happens, that for example this is core inflation, we have these lines that are outside the shaded area, so we have autocorrelation and partial autocorrelation with a lag after the third period, the fourth period, we have and also further forward in the partial autocorrelation we have still there is some autocorrelation or partial autocorrelation even after we do this simple the machine does this simple work of taking the first difference of the data. And then we have the quantile on quantile charts, which are very useful because they tell us, okay, you have this straight line and then you have these dots. All the dots that are on the red line, they are fine, but these dots which are outside, they tell us that there are some data which are outliers that deviates very much from the overall trend or distribution of the data. And so we see that also inflation can be volatile and can have some very outliers or very volatile data, like for example having inflation like 12%, which is something out of the ordinary average trend. It could be 2, 3 or 4%, let's say. So if we go up to 8, 10, 12%, 15% inflation, then it's a bit of a problem because it's some very out of the sample data, then it's a bit complicated. And then in the QQ plot we can see the quantile and quantile plot, we can see how what are the outliers data. So this is CPI classical inflation. We see that we have at the first two periods we have autocorrelation, and then the time series is stationary more or less, although we have a bit of a bump here. So but CPI it's stationary, but you have to be careful when you go around this stuff. Then we can appreciate what is the PDF function and CDF function, which are mostly symmetric to zero, but as you can see here in the tail we have some very high values like 1.5 CPI, and this 1.5% it could be for example that in 1 month CPI increased by 1.5% month over month, or year on year from a month to another. But so that's why most of the parameters are between minus half and minus 0.5 and plus 0.5 are in this range of the distribution. But these very large parameters which are here, you see here 1.5, you can see in the PDF distribution the probability density function, and this is very down far in the tail of the distribution. Sorry for the mess here. Okay, and with all these charts we can see how this data they autocorrelate, or they partially autocorrelate, even if we try to eliminate all the volatility. And yeah, we saw this one. It's yeah, this is core. Yeah, this is core CPI on for US cities on average, all consumers, commodities, less food and energy commodities. Okay, so it's another measure of core CPI. Okay, and we see how there are outliers data of plus 1.5% or minus 1.5%, plus or minus 1%. So these are very large variations month over month. And so going fast forward, we see that the median CPI, even if it's a median CPI, there is an outlier of plus 2 or minus 2%, and the distribution is not really symmetric to zero. You see that it's a bit skewed on the negative side. It's skewed of we have minus 2.5 plus 1.5, so it's not really symmetrically distributed around zero. This is the median CPI. Nevertheless, there is very little autocorrelation and partial autocorrelation. These are sticky prices, which has somewhat of a smaller outsized data, and there is some partial autocorrelation. This is very wide, so we see that there is some sort of seasonality here going on, even if we do the first difference, and that has to do with the moving average. And we can see here in the probability density function that there are some very large data here, plus 4, plus 6, which are very far in the tail of the distribution. And what we can appreciate is that the producer price index in all its flavors, which can be, I will tell you right now, it can be producer price index, bear with me 1 second. Okay, so this is, for example, is a producer price index excluding food, energy and trade services, so it's a very core part of the producer price index. It has like a trend, you can see here. It's like a moving average, so it has seasonality in the moving average of the historical data, and this is very similar for this other producer price index, some sort of moving average seasonality, and there is autocorrelation in the first 3 or 4 lags, and even here. So even if we do the first difference, still there is seasonality and there is some autocorrelation on average. Okay, so this one here, it's producer price index and demand. It's so this is core producer price index, final demand and demand. we have autocorrelation in the first 3 or 4 lags, even longer. There is some seasonality, moving average. And so you see that this data, even if we filter out the volatility, then it's they tend to be the present data it's correlated with past data, so we don't manage in full to filter out the autocorrelation of the data. But anyway, so I start to run the first OLS regression, and some p-value. So we have the dependent variable, it's core CPI. Okay, and so what happens to how core CPI behaves when these other variables they are moving around? So if we take the p-values, those that are more significant, like here and here, then we see that this one is another measure of it's core CPI, yes, excluding food and energy for all commodities. And so when core CPI varies by 1%, then this other measure of core inflation varies by this coefficient, so by let's make it 0.24%. So this is a systematic method to see how inflation and producer price index they move around and how they are correlated. What is the coefficient by which, if core inflation has increased by 1% or 1 unit, then what happens to the other measures of inflation? So this is the median CPI will, for example, decrease by this coefficient 0.018%, so very little decrease, very little coefficient, while sticky prices they will jump by 1%, even a little bit more. We see the coefficient is 1, not 1. So if core inflation goes up by 1 unit or by 1%, on the other hand, also sticky prices, which is another measure of core inflation, goes up 1%. So it means that the basket that the basket of items that are in this time series, CPI core inflation, it's very, very similar to sticky CPI. And so they move by the same coefficient, 1 to 1, more or less. One instead, okay, this one it's core PPI, so excluding food, energy, and trade services. What happens? If core inflation has increased by 1%, core producer price index, core PPI, let's make it broader measure, core PPI has increased up 0 by this coefficient, by 0.20%. Okay, so these are very useful to find out the correlation between variables, and we have the R-squared parameter. 0.95 is a very high R-squared, is very close to 1, so they are correlated by 0.95. I would say 95% correlated, or even 96% correlated. So they move in correlation quite similarly all the time, whenever there is inflation, core inflation, or it's producer price index or core producer price index. They are more or less synchronized. They are moving parts in the economy that go together. So let's see how this OLS regression. Let's check another couple of parameters. Okay, let's see. This is a plain CPI. So CPI, this is the constant term. Okay, so the p-value, so the median CPI, so if CPI goes up by 1%, the median CPI increased by 0.29%. And we have a very similar coefficient for core producer price index. It means that if CPI is up 1%, then core producer price index have increased by 0.29% or by 0. You can see 0.52%. Yeah. So these are the coefficients which are very useful to have a broader measure or a rough idea of how things move around. and this one as well, it's a p value which is important, and this last, oh okay, so if inflation rate increase by if or when inflation rate it's goes up by 1 unit or 1%, also manufacturing producer prices would have increased by 0.20%. Okay, so I find this stuff very useful, and this can give you the OLS regression, can give you an idea of again of how this stuff they move together, and you can I mean, I can go and check all the parameters and see how the R squared, what is the coefficient of correlation between these parameters. So the median CPI, it's correlated with the core inflation, but it's a negative coefficient. Wow, it's a very huge negative coefficient, minus 3.45%. Very interesting. While median CPI is very correlated to inflation rate by 0.42. Median CPI, it's very large correlation with sticky prices, 7 points. Oh, this is a very large coefficient. So this is core producer price index, and the correlation is by 0.20, the coefficient. So let's try and do the other way around. Okay, let's say producer price index for all commodities, and we have here only this parameter, which is interesting. Okay, so when producer price index increased by 1%, these are the measure of core inflation will increase by, you can see the coefficient here, by 1.3%. So we can establish that there is a pass-through effect between producer price index for all commodities and core inflation, excluding food and energy, for all commodities. And instead we have a negative coefficient here for these two. No, a negative coefficient for this one, which is a core PPI measure. Let's see if I find the exact name for that. Bear with me 1 second. So okay, I don't actually find it. It must be somewhere. Well, anyway, it's another measure of core producer price index, which will move in the opposite direction. So when producer price index for all commodities increased by 1 unit, this measure of core producer price index, which excludes food and energy and probably trade services, it will decrease by 0.92. So it means that this core inflation totally excludes all the commodities which are that measure the producer price index for food and energy, while this one is very much correlated. It goes up by 1.14%. That is the coefficient, you can see it here. So we can see how this all these data interact together, are correlated within each other. Okay, let's try and also, okay, this is core producer price index. This will be a bit of a mess to read it, because the thing jumps from here to here. Yeah, because this one is this one. Okay, so let's try and see. Okay, so this is core producer price index. I can appreciate the p-values, they are all very correlated to all the producer price index historical data that we have. This is all commodities, this is excluding food, energy and trade services, this is again excluding food, energy and trade services, and this one is for manufacturing, producer price index for manufacturing. So when core producer prices increase by 1 unit, all commodities have increased by this coefficient 0.19, and core, the other measure of core producer prices, will increase by 0.47, 0.64, which is notable, while instead manufacturing PPI would have decreased by minus 0.16 or 84. Okay, so this is for the OLS regression, and then we can have a very funny stuff and see, okay, this is the seasonal decomposition measure, and what these parameters tell me is, say, okay, in December, oh, this is 2014, but okay, I didn't I was not really attentive to this, but anyway, I will tell you what it is. So it tells you, okay, that's the parameter that I see. It's this one, 0.05. The seasonal parameter is this one. So it tells you here the seasonal parameter is negative. So it tells you, okay, the data that I have observed doing the seasonal decomposition of the data, it's higher by this factor, by this seasonal factor, or the data that I have here, it's less than usual by this seasonal factor. Okay, so when the seasonality data is negative, it means that the headline data, it's less than usual, and you can extrapolate, the machine can extrapolate the factor of the parameter, or the amount by which the headline data it's higher than its seasonal average or lower than its seasonal average. But let's go forward, because this it's obsolete. So then, to be more precise, I did the OLS regression, then I did also the OLS regression for the first difference of data, and then the OLS regression for the residual square data. So first difference data is this table here. We can still see that the kurtosis parameter is larger than 3, even if we do the first difference. It means that there are fat tails in the data, and the first difference also comes out with a mess, a lot of t-statistics, p-values. The t-statistics are not statistically important. The residual tells us that for once the residual, when the t-statistic is not good, that it's good because it tells us that the residual square error, they are not correlated with the main trend of the time series. So this is good because it means that the squared error, they are not correlated, so there are no errors in the estimate. And so, okay, let's take some charts which are much easier to understand. Okay, so what I can do here for you, let me bear with me 1 second. I don't wanna go long with these things. Okay, what I can show you. Okay, okay. Let's start with the ARIMA. You need to understand that for me these things, it's very cumbersome. Okay, so my ARIMA model, these are the forecasts. These are auto-optimized, and there is a 12 months or 6 month forecast. You see the shaded area, it's large, so there is uncertainty in the model. So core inflation should be decreasing, but then increase by the same amount. It's like a moving average for the next 12 months in the range between 0.2 and 0.4. Okay, you see the data today, previous data core inflation was 0.4, this month data was 0.2. This ARIMA tells me, okay, the trend it's between 0.2 and 0.4, so nevertheless it will be always positive. This CPI, it doesn't give out a good forecast. Okay, the SARIMA forecast for core inflation is the same, while instead the SARIMA forecast for inflation rate, it gives me a rise in inflation to 4%, which doesn't reflect the real data that we have today from the PLS, which tell us that inflation is decreasing. So this is interesting for me. The machine is wrong. Okay, or nevertheless, maybe when tariff starts to kick in, then this prediction, although we can see that this shaded area is very large, and it goes from 0 to 8%, so it's very I understand why it's not it's inaccurate, the line forecast. Anyway, this is another measure of core inflation for all commodities. It should be declining month to month. Also the SARIMA forecast, more or less the same in a trend here. This one we can discard it. This one not good. This one sticky prices, not so great. But anyway, okay, ARIMA forecast 12 months for producer price index or commodities should be nice in this trend. Actually, from where the data are now, the latest data, this is the correlation data. Well, I'll find out what is the. Sorry, I'm making a huge mess of this. Okay. So we were at the producer price index of commodities. It should be trending around 4%, and also the seasonal ARIMA model tells me that in the long run, like in 12 months, the producer price index for all commodities will creep up to 5%. Bear in mind that this shaded area is huge, goes from -10 to +20, so the model is going through a lot of uncertainty. And this is another measure of core PPI excluding food, energy, and trade services would be declining, so core CPI would be declining. So the main component of producer price index will be, I don't know, food, energy, and trade services. I have no idea. So these are the forecasts for core PPI, and it seems that it should be declining in the next 12 months, whether it's ARIMA or seasonal ARIMA. This will be pretty much steady. Core PPI a little bit above than 3%, but consider the shaded area from 7 to 0, very huge. Yeah, so more or less we have the machine gives some prediction of a declining core producer price index. This is excluding a theoretical 25% tariffs, and again this seasonal ARIMA core producer price index staying around 4%, declining to 3% in 12 months. You see the line goes well into 2026. Very interesting. And yeah, this is producer price index for manufacturing producers, and it could go up even to closer to 4 or 5%. But nevertheless, you see that the shaded area is very negative, below -5 up to 15. So there is a lot of uncertainty in this data. And yes, you have a table with the forecast, some with the lower estimate or the upper estimate. And for example, you can see here the ARIMA upper estimate month on month. This would be a very high increase month on month. The seasonal lower ARIMA model some months is a negative decline. So the data it's all over the places, and so I did repeat again the ARIMA and started to see if I had some different data, but so the forecast is nice to do, it's not very accurate, it's not very precise. So let's see what we have here. So we start to put some spice and some chili in the data, and we say, okay, if we have 25% tariffs overall, just tell me what is the pass-through rate on all the historical data that I gave you in the code. And so the machine does a pretty mechanic job in taking a 25% and see what is the pass-through rate into the data that I gave to the machine, which are the CPI and the PPI, inflation and producer price index historical data. And we can see the results, like for CPI, all items, we have a very small pass-through. On a yearly basis, it's at 0.20%, so it could be more or less negligible, but I don't take it as a very reliable forecast. And yeah, so we have pass-through rates for all time series. We can see here what are the data. Okay, the most affected theoretically could be the manufacturing sector, and this one, which is let's say PPI for energy, but this is core PPI. This for finished goods, and this intermediate material. So this what could theoretically are the let me make it clear. These are the theoretical pass-through effects in percentages terms here, with a let's say a dummy variable of a 25% tariff on the historical data interpolated for the whole time series, going from 1990 up to the previous month. Can be January 2025. So that is the data. And we have some very nice charts that give us the regression line and all the scattered data points, and we can see by the slope of the regression line how the input price changes for the time series into consideration, and yeah, how the input price changes, how the output price changes. So when the input price is bumped up by 25% tariff, then we have the output price that it can vary by an amount that can be more or less steep, so higher or lower amount. It depends. You can see it with the linear regression. Okay, in this case, the broader CPI, it has a very steep linear regression, so the output, the change in the inflation rate, it could be very steep if these charts it's proven to be really effective from the theoretical simulation to the real world. Okay, so we can see here that these have marginal effects like of a 0.5% change, and sticky CPI could be increasing by 0.3% when we have this bump up of tariffs. The median CPI, it could vary more, and the baseline is somewhere between 2 and 3% here, and then it could vary very much up to 4%. So pass-through rate for producer price index for all end products, it could increase very much. It's totally positive, the change, up to 4%. And we can see here that there is a lot of data which are scattered around, which are very far from the regression line. So this one, you can compare it how the manufacturing PPI, it's much more well behaved, and it fits much better the regression line, but nevertheless the slope is very steep. So the pass-through effects of tariff, it could be very steep in the longer run on all producer price index. So producers will face very high cost in for the tariffs implementation, and then they will have to pass through some sort of inflation that it could be, if we take this, it could be as high as 4% or 6%. I'm not saying that inflation is going to 4 to 6%, but producers, they will have to pass to consumers something between 0 to 6% percentage points of their additional costs. And so this basically, because the overall basket of inflation is a weighted average of all items, for the items that are affected by these effects in producer price index, then the pass-through effect, then it's larger, but in the aggregate would be mitigated on the overall headline index. But nevertheless, we see that the producer price index, they will have theoretically a very steep increase in their production prices. So it's very complicated for businesses, but yeah, here we have another implementation of the theoretical pass-through rate of through the historical time series, and we have some charts. Although these are negligible on a year-on-year, only manufacturing will suffer the most. Let's say will have an impact maybe more or less closer to 1%. Then we can appreciate the data. Hold on one second, my Mickey Mouse stopped working. Okay, yeah, okay, sorry about that. So we can try to see the CPI here. What is the forecast? So the blue line is the historical CPI data. The green line is adjust for the tariffs, and the forecast. We have a forecast. So adjusting for tariffs, we see that CPI, it has a small decline, like in these months, but then it would decline. It would pick up again going forward in 2024, because I specified in the code, I think I specified in the code, yeah, I mean, I think I specified in the code to start to implement the cost of the tariff starting from April, okay, so just to try to make it more closer to the real environment. So we can see here that CPI is forecast to have a small decline, but then to increase again in 2025, when times goes by, let's say like that. And but instead we have some other different sorts of outcomes for producer price index. Either the forecast is for a decline, which is very interesting. Sticky prices, they would be in this range, but we can see that the output, they are not very accurate. So I can try to navigate through the charts and see, okay, maybe there is some reason to take into account these charts. Let's say the median CPI, which seems more reasonable. After a small decline, it will be in trend, and then it will be increasing to 4%. So for the output of these charts, they are really out of the ordinary. So the PPI manufacturing index, it's more realistic. It tells me that it will be in this range. It will be between 0 and 2%, 3%. I don't have the precise scale here, so, but I mean, not very nice. I said from the beginning, it's not very easy. The output of the machine is not very precise, and I've tried and repeated again and again and again the charts just to try to extrapolate. You see, I repeated again the same, and I had the same result. I did not follow Einstein rule, and yeah, I got the same result, which is not very nice. So what we can see here, we can try to have a butcher at the conditional volatility models, and we see that in the past years, even if inflation has been around this trend of conditional volatility, let's say a little bit more of 0.15 units of conditional volatility, but between 2020 and 2024, 2025, we see that there has been a huge spike even in conditional volatility for CPI, and we can see this for all charts. So the Garch model, all these conditional volatility models, they are very precise because they only go through the historical data, they don't do any forecast. But nevertheless, we see that there has been a huge non-normal conditional volatility. And this is very indicative, but we see that the trend basically has been decreasing steadily. It's been very spike up and going down. So the data has been stabilizing going after 2022, 2023, 2024. So the conditional volatility has been decreasing, and it has been stabilizing month over month going forward in time. Now this other variable will be very interesting. So this PPI has showed some higher vol lately, also this one, and probably maybe it could have been due to tariff announcement or some other factors which are not explained in the Garch model. We can appreciate that the producer price index conditional volatility has been increasing even before tariffs have taken place in the economic environment. So if tariffs tend to push up prices, then we can expect that conditional volatility will tend to go higher. And then what will be the pass-through effects on inflation? We can say, for example, that the pass-through effects will be in a range between we can theoretically extrapolate from data 0.2, 0.4 on a month-over-month basis or on a yearly measure, let's say. Then with the charts, we have I have the Garch parameters, but it would be very lengthy. But nevertheless, what is important to see here is that the p-values, they are statistically important. So even if these are measures, are historical data of prices in the economy, retail prices, consumer prices, producer prices, we can see that the conditional volatility econometric study, it's important, and the parameters tell us that the past shocks of inflation, they in this case for CPI, they determine 18% of what is present day prices of retail prices, and the persistency of past shocks accounts for 78%. So that's why the Garch model can give us some parameters and a framework on how to understand how past shocks of prices and can be determinant for today prices, and how high prices are persistent. So they can be persistent for 78%, according to the beta parameter. So once you have an inflationary shock, those prices, they remain high, okay, and then basically the decline in the inflation rate, it's due to the base effect. So once, for example, a kilo of bread goes from $1 to $2, and then you have the inflation shock, and it goes through the data, and then the data captures the inflation shock. But then when you after some time, like in 2024 or 2025, we see that the price of bread stays at $2 and doesn't change much. Maybe it goes at $2.10. So the base effects starts from a higher price. So you have the data is misleading because you have a perception from a percentage measure of how the price has changed, that the prices are not increasing. No, but the measure of price, they start from a higher base. So the bread doesn't cost $1 any longer, it costs $2. So it's already very expensive, and of course it's very difficult that it becomes more expensive than that, because otherwise consumer demand will collapse, will start to cool down. Yeah, if so, the Garch model, although it's a measure that it's used for financial assets or for option pricing, things like that, I personally I find it very useful to measure the volatility of inflation, which is another very important academic branch of inflation. There are lots of studies which look at the volatility of inflation rather than the headline percentage changes on the inflation rate or core inflation rate or the producer's price index. So because with the volatility of inflation you are able to capture, you see that lately the producer price index, the conditional volatility has increased even before tariffs have been incorporated in the data. And so there are some other factors which are not visible in the headline percentage changes. And with the Garch parameter, the alpha and beta parameter, or the gamma parameter, when we want to utilize a T-Garch model or a patch model, with the gamma parameter we can see the asymmetry of the shock. Okay, so just one second, I want to understand. Okay, yeah, still is CPI. Okay, CPI, inflation rate. This one is a T-Garch. Okay, T-Garch model, a patch model for CPI. Yeah, CPI all items. Okay, so it's very clear. We have a gamma parameter. So the T-Garch model tells me, okay, past shocks, let's say they determine or they predict or they influence prices by 15.8%. Yeah. The beta parameter, again, it's very similar. They tell me that the persistency of inflationary shock or past square residual on the following data or the following conditional volatility, in this case of inflation, is 78%. Then this parameter gives you this model, the T-Garch, A-Patch model, or the GJR-Garch model, they give you another parameter, which is the gamma parameter. And this gamma parameter, it gives you a coefficient in terms of, okay, so the asymmetry of the shock, it's of 4%, 4.17%. Positive. So what happens is, when I have inflationary shocks, past shocks determine the following period by 15.8%, the persistency of the inflationary shock is 78-79%, and the asymmetry of the shock is of a magnitude of 4.17%. This is very useful. This is about the conditional volatility, but I mean, for me it's very interesting. I love to study this stuff, and it's very rude if you find it boring. Anyway, keep watching and like the video. So conditional volatility, tell me conditional volatility data, whether it's inflation or producer price index, all the results, they tell me that past shocks like this alpha parameter, it's incredible, 1.5, it's even more for CPI, E-Garch model. So there is a lot of past square residual shock that explain past inflationary shock or past conditional volatility determine a lot what happens thereafter with inflation. So it's very, very interesting. And what we can say on a broader measure is that inflation, consumers and the producers, consumer prices and producer prices, they are very much correlated and determined by past shocks. And when you have you have an inflationary shock, the inflationary shock is persistent, and when prices go up, they stay higher, and it's very unlikely that prices go down. Same again, if the price of bread goes from $1 to $2, it's very, very difficult that the price of bread goes from $2 to $1.50. It's very, very likely that the price of bread will go from $2 to $1.10. It will grow slowly by a smaller percentage. Okay? So this is very important to understand what is the dynamic of prices in the economy, what is the dynamic of producer prices, which is costs of production in the economy, and how far the pass-through effect of these parameters, the persistency of past inflationary shock, how past inflationary shock determine today behavior of prices, and what is the asymmetry in the shock, if it's a positive asymmetry or it's a negative asymmetry in the shock, so that when you have prices going up or volatility increasing for retail prices, like in this case, volatility of producer prices will be higher because you have this exogenous factor, which is imports tariff. But on the other end, the global economy will see tariffs also for exports. So products that will go out from the United States and will go to another country, they will be subject to tariffs. And products that will go from another country into the United States, they will have tariffs. So industries or manufacturers or those that produce goods, producers, they will see a lot of volatility in prices because supply chains, they will have to adjust to these tariffs. And then if there are further changes of this imports-exports tariff policy, then there will be more volatility. And these inflationary shocks are likely to persist across time. So if this month data, the data of February, they paint a rosy picture for inflation, okay, it's all well and good. Let's say the Federal Reserve will cut the base rate from 4.33 to 4%. I don't mind. It's not got nothing to do with them. It's not my issue. I mean, but nevertheless, I would be very, very careful that when from April we see that more volatility will persist across retail prices and producer prices, we could well see that this measure of inflation will start to go up again. So there will be another sort of inflationary shock in the economy, either in the United States or in Canada or in Mexico or in Europe, and that will be they will put offside. The central bank will be offside, will be caught really offside because they cut interest rate, and then if inflation starts to creep up again, and then it's a huge mess for monetary policy. And then it will be very, very interesting to see what is the volatility in financial markets. We have already seen a correction in what I would call the Biden bubble, so the 6-7 fiscal deficit bubble, and the AI bubble. But I mean, the correction, it can go 10, 20%, even more, because in stock markets they are very, very, very inflated. They are inflated a lot. So the valuation of asset prices could be very much sensitive to volatility in headline inflation, for example. So if volatility in inflation goes up, and then from next month or from April, May, June, and going forward, and for example in summertime when there is more activity because the weather it's more it's nicer, it's hotter, then prices start to go higher because we see a pass-through effect from producers to the retail and then consumer. Then it's an issue for monetary policy. It's an issue for financial assets, and then I don't know what will be the fiscal position, because 25% tariffs cannot solve a 2, 3, 4, 5 trillion deficits, or a 5 or a $2 trillion deficit, or a, I don't know, 5-6% fiscal deficit. There is no way you can. The math doesn't. It doesn't work like that. It doesn't work like that for sure. So it's a red herring. It's a false herring. Okay, then I tried to have some conditional volatility forecast for this inflation time series, and according to the models, then we can see, okay, the conditional volatility going forward in 2025, this is without the conditional volatility forecast is without the exogenous variable of without the tariffs. Okay, it's just plain data, only the data, and that's it. So in normal times, conditional volatility for CPI should be somewhat decreasing for all the models. On a yearly basis, instead, we have a huge upside for the EGARCH model, which is not in line with this trend here, so I would not consider this one. It's very too much of a conditional volatility on the upside, but nevertheless the trend is slightly higher, 0.5 let's say standard deviation in conditional vol of 0.5 units. Okay, CPI, core CPI, it says here shelter, I don't know why, but nevertheless conditional vol is supposed to be increasing net of tariffs, without tariffs. Sticky prices, declining conditional volatility for all 4 GARCH models. Median CPI, we see that will be pretty much steady, while EGARCH model, while these other 3 models is EGARCH, TGARCH, APARCH, declining. So there is some sort of discrepancy. So producer price index for all commodities. So all the orange line or the yellow, which are the EGARCH model, they tend to have a lot of asymmetry, while instead these other 3 GARCH, classic GARCH model, 1-1 model, TGARCH and APARCH, they are more in line, and nevertheless we have a rising trend of conditional vol for all commodities, producer price index, all commodities. Finished goods, let's say finished goods, so excluding cost of food, energy and trade services, somewhat of rising conditional volatility. Intermediate materials, rising conditional volatility. This is without tariffs, yeah, and this is consistent with the other charts that we saw of past conditional volatility that has been rising nevertheless. And manufacturing also, there should be some rising conditional vol in producer prices, and we have the result tables. We can appreciate 2025. I can compare the conditional volatility forecast with what will be the data, the actual headline data. So take a screenshot of the data. If you don't, that's very rude of you. That's very rude. That's very rude. So some parameters, see the EGARCH model, they are huge. So there's too much of a discrepancy between the other models. So what I would consider is the GARCH model or the TGARCH model and the APARCH data results, and I will compare it with so for example, we can see here conditional volatility CPI all items 0.02. If I take this in percentages terms, it's exactly as this one, CPI inflation rate month on month 0.2%. If I consider this, well, this would be 2%. In percentages term, it's 2%. But nevertheless, I will need to have one more zero in here. But if these are percentages, then it's equal to 0.2%. But now I'm messing around with this stuff. Nevertheless, I will take this data and I will compare it with the headline data, and it will be useful for my own study, which are full of errors, but what to do. Then we have another ARIMA model which tries to give us another forecast. So this is core inflation. We have a lot of uncertainty. Core inflation, as we said, it will be in a trend between 0.2 and 0.4, which is consistent with the data that we got today. CPI is projected to rise. Okay, and let me see. Okay, if there is the 25 tariff data. Arima optimization. No. Forecast look through. No, there is no. So this is without tariffs. Okay. CPI forecast to rise. Testing data shows us that CPI goes down, which is more in line with the headline. The Sarima model gives us a rising CPI. This is another measure of core inflation, which is in around 0, will stay pretty much in trend. Median CPI is projected to decline to 3% or 2.5%. This is sticky prices. That should be declining to 0.4, rising to 0.5. The training data set, then we have this yellow line, which is in the shaded area. Testing data set is here, will tell us that the sticky prices will be between 0 in this range, 0.2 to 0.4, while the Sarima model gives us a seasonal uptick in the sticky prices. Producer price index for all commodities, they are predicted to increase. By even the test data or the Sarima data, while the Arima forecast it's pretty much unchanged. Okay, core producer price index, the Arima model is for a decline towards 0, while the seasonal Arima model, the seasonal Arima model, it says the core PPI will be around 2%. These other measure core PPI like finished goods, excluding food, energy, and trade services, should be increasing to 4% here. You see, this is without tariffs. It's just the machine giving out some outputs. Core producer prices steady to going up to 4%, and this is another measure of core PPI that would be increasing. There would be somewhat volatile, very volatile. Went down, be negative, and then go up again. Very interesting. And yeah, we have a table of the data. Okay, so overall, what is the takeaway of the whole thing? Takeaway is nothing to take away. Nothing really to take away. What the Arima model, the seasonal Arima model tell me that core producer price index or producer price index excluding food, energy, and trade services, they should be increasing in 2025 even up to 4%. And also the classical measure of inflation, CPI, should have been increasing. Yeah, you see a CPI, the Sarima forecast, 6%, very huge increase. But we saw that today's data, they give us trend inflation, core inflation, and CPI declining slowly, which is better, okay, than having a Arima forecast and forecasting rising inflation. Although the testing data, you see that it's more, it's much closer to declining CPI. That will be in and around 2.5%, 2.8% more or less. So the forecast is that the Arima and Sarima model, only considering the data, they tend to forecast rising producer prices costs, producers costs, and consumer inflation, consumer price index, and core inflation rising to 2, 3, or 4%. What we can take away from the conditional volatility is that conditional volatility somewhat would be increasing by 0.5 or a little or less than 0.5, or slightly decreasing for the median CPI. So considering only the data, the historical data, CPI inflation conditional vol should be increasing a little bit. Same for producer price index or core producer price index. And I try to explain you that past inflationary shock, they tend to persist across time in prices. So prices, they don't tend to go down, but they tend to go up, even if at a slower pace. And with these charts we can see how more or less the steepness of the uh, the uh, the CPI or core inflation or PPI according to the by simulating a 25% tariffs, and these are some sort of table results for the pass-through rates on all time series. You can see what are the coefficients. Some are larger, like 0.2%, manufacturing 0.72%, PPI, this is not energy, this is core PPI 0.23%, and finished goods 0.10%, medium PPI will increase by 0.07%. So these are all in all marginal inflationary pressures, either on consumer prices than producer prices. And so what we can take away is that the inflation data of February have been decreasing. If we take the inflation trend, we can consider that inflation will slow down, which is good, will normalize. If we will have to wait for more data to see if the theoretical forecast of this marginal inflationary pressure on CPI and producer price index will materialize, let's say in a range by 0.2 0.4% for CPI or core CPI or producer price index. Let's put it in this range. It can be more, it can be less. I say it is very, very difficult, and it's by no means this is a precise forecast. Nevertheless, what I can say for sure is that volatility of inflation is persistent. And then I will love you and leave you with another thing which is very, 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 very nice. And I prepared this for you, which is a fancy stochastic model. It's called DSGE, Dynamic Stochastic General Equilibrium Model. So what this does is basically give you some data to understand what is the stochastical behavior of the adjustment on the basis of what is the Philip curve, the discount factor, the inflation gap, and the output gap. So what this tells you, it tells you what is the response function of the federal funds rate vis-a-vis what is the inflation gap and the output gap. Okay, so the discount factor or the beta parameter, it's basically, it measures the sensitivity of consumption compared to past trend. So how consumers decide to allocate their disposable income to consumptions on the basis of inflation, and what is their marginal utility or their preference. So if they prefer to have immediate consumption, or they prefer to postpone immediate consumption and see more utility in postponing immediate consumption. So it's about the marginal utility of the consumer behavior measured by the variability of inflation, consumer inflation. Then it measures also, you see here, Phillips curve slope. So it derives the slope of the Phillips curve, and on this basis it tells you, okay, for a 1 unit increase in the output gap measured, the Phillips curve slope measures at 0.20 increase in inflation. Okay, so with the lower unemployment, and then or an increasing output gap, a positive output gap, then inflation measured by the Phillips curve slope it bumps up by 0.20%. I know I'm explaining very bad, but this is very, very interesting because it helps to visualize what is the response function of the federal funds rate according to what happens into the economy. So if the output gap, consumers they are neutral towards their marginal utility of consumption. So the beta factor, because it's very close to 1, there is not much preference in their marginal utility for consumption of consumers. What the Phillips curve tells me is that if there's a positive output gap and inflation goes up by 0.20%, okay, and this means that when you have full employment, then there is inflationary pressure, and the coefficient by which inflation goes up, it's 0.20%. Then when you have an inflation gap, what happens? By the Taylor rule, the federal funds rate works 1-to-1. So every time the Federal Reserve has seen an inflation gap in the economy, it has jacked up the federal funds rate by 1.01%. So inflation, if you have an inflation gap that it's higher of 1 unit, then the response according to the Taylor rule measure of the federal funds rate, it has been of 1%. So it's 1-to-1. Inflation up 1%, federal funds rate, they tend to be up by 1%. And it's very interesting, this data. So when you have a positive output gap of 1%, then the federal funds rate tends to be moved up, tends to be increased by 0.55. Okay, so we can see the response function of the central bank. It's 1-to-1 when you have an inflation gap, and of a 0.55 vis-a-vis 1 unit increase of output gap. So the central banks naturally tends not to kill off a positive output gap when the economy is going at full potential or above full potential, because it means that the economy is growing. So the central banks doesn't want to put the hard brake on a growing economy, so it tends to hike interest rate by half a percentage point, 0.55. While instead, when you have periods of high inflation, the reaction function of the central bank, it's direct, it's 1-to-1. Inflation is it's up 1 unit. Federal funds rate, it's hiked by the same measure, by 1 unit, and there's little more, 1.01. Okay, so this is very, very interesting, because it explains with a stochastic measure the dynamic adjustment of monetary policy measured by the interpolation of the Phillips curve slope that gives you a parameter, and by measuring the Taylor rule. Now the Taylor rule is, I don't know if it's utilized a lot. It's somewhat in modern monetary theory, it's considered an old school concept, but we can see here that still it's a lot, it's valid, it's very interesting, because it clearly tells you, okay, if you have an inflationary gap, then you need to hike interest rate by the same measure, 1-to-1. While instead, if you have a positive output gap, you need to hike interest rate by half a percentage point, just not 1-to-1, by half measure. Okay, and so with this, love you and leave you. Remember, the takeaway is that there will be a pass-through effects of tariffs in inflation and in producer price index. We will have to see by how large will be the volatility in production cost and in consumer prices, and how then the headline rates, the broader statistical measures, they will adjust. I will wait for more data, and that will be very, very interesting. And I will be back to you very soon with some more interesting content. So please keep watching, subscribe, like the video, and thanks a lot. See you the next time very soon. I hope so to see you very, very soon with all my heart.